Welcome to the episode 8 of the coin flip trading, a trading strategy that is based solely on the coin flip. You get heads, you buy, you get tails, you sell. It's as simple as that. So no other technical analysis tool is actually included, and we don't use anything else to determine the direction of the trend. So 7 trades in, we are still profitable, and we're gonna make an assumption, or we're gonna sum it up together after the 10th episode, after the 10th trade, to see what really happens after a period of trades. And in this episode, we're gonna be talking about one thing, one very important feature or order, whatever you wanna call it, and that is the stop loss. So what it actually is, well, it is an order that you place with your broker account in order to sell a security or whatever you are trading. It could be Forex or whatever else, in order to make sure that when it reaches a specific price, then the stop loss is going to be triggered, and it's going to reduce your risk, and it's going to make sure that one trade doesn't wipe out the entire account. That's the principle behind it. But you probably know what it is and how to use it. But the important thing is, how does it apply to our strategy? What does it have to do with the coin flip trading? You should keep in mind, and based on my videos, you probably already know that the only way to exit a trade is when it reaches the stop loss or take profit. We don't end or exit the trade manually. We only focus on reaching a specific price level, and we focus on the automatic orders to kick in. That means that it can be either stop loss or take profit. That's why you can probably tell that it is very important to have one. I mean, it's crucial and necessary for this strategy, but where exactly should you put it? Since we only guess where the trade is going to go, whether it's going to go up or down, we don't know for sure, or we don't even know if we are right or whatever is going on. It's just random based on the coin flip. That's why we need to set a specific amount when it moves one or the other direction. The amount of pips the stop loss is away from the actual price level is the same amount of pips the take profit is away from the price. So it can be either one direction or the other. And how many pips exactly? Well, that's why we take a look at the ATR, the only indicator that we use. It's not really to determine the direction of the trade, but rather how much the chart and the thing actually moves. So it just counts the average amount of the pips that the chart moves. I mean, it's pretty much the average from all of the candles within the last 14 periods. And based on that number, we set the stop loss as well as the take profit. But that's not really the end. When you know where exactly the stop loss should be, you also know and have to know how much it's actually going to be in cash, in money. It should be the 2% of your entire account. I mean, this is common knowledge, but this is how much you actually can risk in order to make this thing actually make sense in the long run. So you have to count it out, and based on that, you have to adjust the volume and how much you actually gonna trade with. So that the 2%, that the stop loss is not gonna be more than 2% of your account. So it's pretty simple, right? Okay, now let's finally get to the actual trading. You can see this is our account. We currently have 2,039 euros on our account, and we're going to choose something to trade. I really have no idea what it's going to be. I will probably go with the Forex, because last time I was trading indices, and it's not a really good idea because those actually have the tendency always to go up. So I will rather focus on Forex, where it's a little bit more random there. Okay, so let's get to something like, so let's open up, for example, US Swissy pair, and well, we get it to the 4-hour time frame because this is the one that we use, and we only need to determine the direction of the trade. So flip a coin.
It's tails.
And as you can see, it's tails. That means that we are going to be selling. So let's set everything up. Also, let's take a look at the ATR, because that is also important, like I've talked about. The amount is 15. It's not much, but that does not really matter. We have to go with it. So now we just set the take profit as well as the stop loss about 15 pips away from the price, and the amount we actually risking has to be about 40 euros because that is roughly 2%. So let's just open the trade and I'm gonna update you on what's going on after we're done. Now here we are, it's literally been about 30 minutes and the trade is already closed. We are in green, that means that we made money and that means that the trade was successful. So let's recap it a little bit. So this was the 8th trade and there are 2 more to go before we summarize everything. And the thing is that no matter what happens next, we are not going to be in a negative. We're not going to be in red numbers no matter what. Even if we lose the next 2 trades, then we're going to be at break even. So that's the great thing about it. But there's also a chance that we make 1 more profitable or even 2 more profitable trades. And that's going to end up in our trading being very profitable, considering that we are just focusing and relying on the coin flip. So if you like what you see and want to stay all the way to the results and then to the next trading strategies, then make sure to subscribe and become part of this community where I try to post this kind of stuff. So thanks a lot for watching. See you guys later in the next one.